Hi, my name is Vishal Khandelwal and I am talking to you from Safal Niveshak. Over the past few days and weeks, I've received several queries from the readers of the Safal Niveshak post and also from the value investing course that they need a simpler explanation of the concept of present value. Present value, as you know, is the most fundamental and the most important concept in the field of finance. It is one concept on which all investment decisions are generally made, whether it's an investment by a company in another company or investment by an investor, by an individual investor in a stock. So it's a very fundamental concept. It's the basis of everything in finance, and so let's discuss the concept in a simpler manner. I'll try to make it simple as possible. So let's discuss the concept of present value. The present value. Now let's think of a situation where I offer you rupees 100 at this point of time, currently now, and the other option where I say that I guarantee to give you 110 rupees 1 year from now. So what I say is, now I'll pay you rupees 100, or 1 year from now, as 1 year from now, I'll pay you a guaranteed rupees 110. And believe me, it's guaranteed. I'm not saying maybe I'll give you, I'm saying it's guaranteed that I'll give you 110 rupees in a year from now, or 100 rupees now. Now the question on you is, which option would you take? Option 1, where I give you 100 rupees now, or option 2, where I give you 110 rupees in a year from now? Suppose you say, I want 100 rupees now, because you want to be more certain with the money you get, so you don't believe in me, and you say, I want 100 rupees from now, and I rather invest, I'll rather put that money in a bank and earn 5% interest and get 105 rupees certain in a year from now. So you say, I'll take 100 rupees from you now, and I'll invest it at 5% and get a confirmed rupees 105 in a year from now. How did I get to the calculation of 105? I simply multiplied 100 into 1 plus 5%, which is since I'm getting 5% interest, I'll multiply it by 1 plus 5%, which is 1.05. so this 100 into 1.05 will give me 105 rupees 1 year from now. Now coming back to the finance concept, 105 is the future value of 100 rupees, because you are getting this money in the future, and 100 is the present value of 105. So this is the PV, which is the present value, and this is the future value of 100 rupees. Coming to the second option, 110, as I said, I'll give it to you 1 year from now. So this is the future value, 110. This 100 rupees is the present value, and this 110, since I am giving to you in the future, this is the future value. Now you want to calculate what is the present value of this 110. So we'll do a reverse calculation. Here we multiplied 100 by 1.05 to receive 105. What we'll do to get to the present value, we'll divide 110 by 1.05. So the answer as I've calculated is 104.76, and this is the present value. Now if you see, in both the cases, the present value here is 100 rupees and the present value here is 104 rupees. Now you need to decide for yourself which is more valuable. Of course, now you'll say that 104.76 is more valuable because you know the present value of 110 rupees. Earlier, since you did not know the present value of 110 rupees and you were not sure whether I'll give it to you and what is the kind of interest that you'll earn, you said that you'll go for an option 100, where you can simply get a 5% interest and make it 105. But when I say that I give you 110 1 year from now, which is the future value, I do a reverse calculation and come to a conclusion that at 5% interest rate, which is the same, the present value of 110 rupees is 104.76, which is more than the 100 that I am willing to give you now. So now you'll go for the option second one. This was a simple explanation of the concept of present value and future value. Coming to two terms which are very important here, This is 5%, is the interest, which is also known as the yield. The yield or the interest rate that I am going to earn on 100 rupees. When I use the other calculation, when I try to calculate the present value, I am using the same 5%, but this 5% is known as the discount rate, because I am discounting the discount rate, because I am simply discounting 110 rupees to bring it to the current level. So when I discounted the 110 rupees by 5%, I get to a value of 104.76, which is more than 100 rupees now. So these are the current values. This is the present value now, and this is the present value of 110. Now it's easier for you to decide which one you should go for, and definitely you will go for the 110 now, because the present value is higher for 110 1 year from now than the present value of simply 100 rupees. This was a simple explanation of the concept of present value. As I said, it is very important concept when it comes to investing in stock markets. When you try to calculate the value of a stock, instead of this 100 rupees or the amount that I promise to pay, what you discount is the cash that the company is going to throw out every year, because cash is the most important thing in companies, the amount of cash that it generates year after year. When you try to calculate the value of a stock, you simply try to calculate, let me come a bit down, you simply try to calculate the discounted value, the present value of the cash that the company is going to generate year after year. So assuming this company A, which generates cash of say 100 rupees in year 1, say 120 rupees in year 2, say 110 rupees in, because this is a absolute number year after year, it's not cumulative. So this is the amount of cash that the company generates every year, right? So, and in year 4 it generates 140 rupees, and year 5 it generates 170 rupees. Now how do you calculate the value of the cash that the company is going to generate, because the cash belongs to you, the investor? You simply do the discounted present value calculation. So the value of this 100 rupees 1 year down the line, assuming you believe that the real interest rate in the market is something that you will get at say 5%, you say that why should I invest in a stock which gives me these kind of cash flows? I should rather invest in the market which gives me 5%, and for example a fixed deposit which gives me 5%. So that 5% will be your discount rate. So you'll calculate the present value of every year's cash flow. The first year's cash flow will be like 1.05, yeah, raised to power 1, because this is the first year cash flows. The second year cash flow will be like 120, will be 1.05 raised to power 2, because we are trying to discount the 2-year forward cash flows to the current level. Similarly, the third year cash flows we discount simple by 1.05, the discount rate, by 3. The fourth year 140 discount, but this discount rate for the fourth year, and the fifth year is 170, 1.05, which is a discount rate, by 5. When you calculate the value of these numbers, you arrive at say an XYZ figure, right? So this XYZ is the XYZ is the present value of the cash flows which the company is going to generate over the next 5 years. So this is the present value. These are all future values, but you are not worried in the future value. You want to know what is the current value. If I were to invest in a stock now and I expect these kind of cash flows over the next 5 years, what is the amount that I am going to pay for the stock? So you calculate the present value of all these future cash flows. Remember, you add all these 5 figures. You add all these 5 figures to arrive at the cumulative present value of all the future cash flows that the company is going to throw out, and it belongs to you as an investor. So the present value is a figure which will tell you, and the most important thing is, in absolute terms the present value won't make sense. You need to compare, assuming instead of XYZ, take a number. Let's take a number. The number, for example, the present value, the total present value of cash flows is say 200 rupees, and the stock price, this is the present value, right? And the stock price is say rupees 150. Now what is the kind of decision you will take? You will see it's again the same concept. You are paying 150 now, and versus, for example, here you are getting 100 rupees now, or you want to take 110 now. Here you are getting 200 rupees of present value of cash flows over a period of 5 years, in return for the rupees 150 that you can pay now for the stock. So you need to do the calculation that the cash flows, and remember, this is the present value. This is not 200 rupees that you will get over the next 5 years. This is the present value of the future cash flows. So you're comparing the present value of 200 rupees versus the present value of 150 rupees, and obviously you will go for this decision, which is like, I'll buy the stock because the value of cash flows is 200 rupees present value, and the stock price currently is only 150, which is a 25% discount, yeah, to the present value. So this is a simple calculation. Of course there's some other numbers which come into the picture as you go deeper into the present value calculation, but this is most simplest way that I could have chosen to explain you the concept of present value and how to utilize the concept of present value to calculate the value of a stock. And we've discussed it. Readers of the value investing course know that we've discussed this concept in lesson 7 of the value investing course, and I've also discussed it recently in my stock analysis of Larsen and Toubro. So try and understand. I hope I made it simpler for you to understand the present value concept. And remember, this is a very important concept. It's very simple to calculate, but it's a very important concept in finance, because everything related to investment revolves around what is the present value of X amount of money in the future. Whether the X amount of money is the cash flows that the company is generating, which I am receiving in the future. I want to know what is the present value now. I am not sure about the future. What I am sure about, what I want to confirm now, is what is the current value. And the present value calculation is what helps you understand what is the current value of the future cash flows from a business, or your future investment and the returns that the investment will earn you over the next, say, 5 years, 10 years. So what is the amount that you should pay now to earn such a kind of interest? And why is it an important decision? Because it helps you choose between stocks or between other investments. If something is giving me a present value of 200 rupees and it's available at 150 rupees, and if something is giving me a present value of, say, again 200 rupees and it's available at 250 rupees, then of course I will not take the second option, because I am paying 250 rupees to get a present value of 200 rupees. But in this first option, for a cash flow present value of 200 rupees, I am only paying 150 rupees, which is I am paying lesser for a higher cash flow, right? So even in this calculation, instead of taking 100 rupees, if I take 110 rupees 1 year from now, when I do the present value, that value of that 110 now is 104 rupees, 4.76 rupees, which is more than the 100 rupees. So I'll of course take the second option. So the present value concept not just helps you in valuing companies, stocks, but also helps you in deciding which is the better option in terms of valuation. So that was the present value calculation. I hope I made it simpler, and I hope you understood the concept now. Thanks a lot. Thanks for being there.